Good afternoon, everybody. Today I'm chatting with Michael Miller. So Michael has been on the show before, but he recently just wrote a book called The Big Raise. Now, if you've watched some of the previous interviews, I've mentioned that Michael is a really close friend of mine. He's somebody who I can always call with questions ranging from anything involving securities law, regulations, accounting. He seems to know more about the venture capital world in accounting and finance than anybody I've ever met. And I'm really proud of Michael for having written this book because I know he's put in 3 years writing this book. But more importantly, if you are interested in ever starting a company or getting involved in venture capital, I think that this is a book that you gotta read. I actually went to university to study entrepreneurship and finance. And one of the things that I noticed was that I wasn't really learning a whole lot about raising money and all of the entire challenges that exist when you try to put together a venture and you don't even know where to start in terms of legal, in terms of the types of funds that are out there, the types of financings that exist. The truth is that if you go to school and you try to learn about this stuff, most of the professors don't have the real world experience to explain this stuff to you. And I feel like this is almost a textbook, but it's written using sort of a witty tone that walks you through all those little nuances that you really should know about if you want to go out and try to raise money. So if you've ever had any interest in trying to go raise money, or you just kind of want to learn a little bit more about the VC world, this is a really interesting read. All right, everybody, enjoy the interview. Michael, thanks so much for joining us today.
Yeah, it's great to be here.
So you got your new book, The Big Raise. What inspired you to write it?
So I have a background in venture capital, and I've worked with a number of companies looking to raise money for early stage opportunities. And a common frustration I had when I would interact with these companies is that a lot of companies who had great ideas weren't actually able to successfully raise money. And it's one thing if you have a bad idea, but when you have a good idea and you can't raise money, it seems like a complete tragedy for the people who commit themselves to do it. And compounding this was the fact that a lot of these mistakes that people were making when they were going out to raise money were entirely preventable. So I started cataloging these over the years, and I ended up speaking to a friend of mine who I did my MBA with, who was working in Silicon Valley as a corporate attorney. And I had a number of calls with him and started describing the problems I was seeing in the market. And then he said, well, why don't we do something about it? So we spent 3 years together working on a book that would help entrepreneurs go out there to raise capital. And after 3 years, The Big Raise is the result.
So Michael, when I was reading the book, I noticed that the language was really easy to understand, and it was sort of void of that, standard corporate lingo that can be easy to get lost in. Who is the target audience for this book, and who specifically were you sort of writing for when you put this book together?
Yeah, so when we wrote the book, we looked at a number of different texts that were already out there. And for many of them that we found, there was a level of technical complexity that would have prevented many entrepreneurs from being able to actually get through the work and understand it. So when we started the writing process, we said, okay, let's put ourselves in the shoes of a 20-year-old entrepreneur who has no finance background, no legal background. And we're going to have to understand and convey to them a variety of concepts around debt and equity and how to actually raise money and different legal terminology. So we wrote it in an accessible way where even if you have no background as an entrepreneur, you should be able to get through it without having to put it down, go to Investopedia, and figure out what we were talking about. So this book is for anyone who's an entrepreneur looking to raise money. And it also has a lot of value for investors as well, who might want to understand some of the mistakes they might be making when they're investing in these opportunities.
So I know the book's filled with lots of anecdotes of mistakes that people make. I want to share one that I've sort of encountered over the last year that I thought was really interesting, where one group came to us. They had a mining deal. I thought it was super attractive. But when we started going through the budget with them, they couldn't explain any of the line items when we tried to get a little bit granular. Not that granular, but a little bit, okay, so you need to spend this much money on, geophysics, and where's that going? Who are you using, et cetera. They couldn't answer that. And then I noticed that after we declined trying to help them out with their deal, they went on to 6 other groups who all declined them. And my takeaway from that was that if they had taken the time to understand exactly where all that money was going, they would have had a much easier time raising money. Now, it's possible other groups found other problems with the deal, but that was our experience. And it leaves me with the question for you. What are some of the most common mistakes that you see with young entrepreneurs or entrepreneurs in general who are trying to raise money?
Yeah, no, just to take your example, I mean, around, we always tell people build a financial model. It's not going to be perfect. I know you don't have a crystal ball. I don't have one either. But if you don't go through the exercise of actually building a financial model, you're not helping yourself. Building a financial model for any opportunity is a wonderful exercise because it's going to force you to do research. It's going to force you to crystallize your thinking. It's going to force you to come up with answers for tough questions. So if you need to hire out 5 salespeople, what are you going to have to pay them? What was the commission structure going to look like? Because that's going to ultimately affect what the returns of the company are going to look like. So I know early stage entrepreneurs can be really cynical about building financial models. And some of them will just say, well, I'm not going to do this. There's no point to it. A smart investor will just know what we're doing and they'll dive in. But like, not having a financial model prepared is a good way to get caught when you're going out to meet people. Because to your point, one of the first questions you get asked in the fundraising process is, okay, well, how much do you need? What's your use of proceeds and how long till the money runs out and you have to go get more in the market? And if you don't have good answers to these questions, and I understand that it's educated guesses, but if you don't have at least some kind of semblance for these questions, you're going to find yourself in trouble. And, investors like yourself are going to say, I'm going to take a pass. So,
yeah. And for myself, when I look at those opportunities, I know that often when we're going to go help a company out that's in that particular situation, we're going to open up our Rolodex and try to help them find the money that they need. And if we raise, let's say, $1 million or $2 million for them, not that I'm in the business of raising money, but if some investors want to join me, they're going to join me. And that money gets spent in ways that we can't explain. Then I've got to turn around and talk to my network about how we kind of led the charge into this investment that, quite frankly, we can't explain where any of the money went and why it's a zero. So just seeing that happen just sort of made me go, I just can't get involved here. I don't have enough comfort with this group.
Yeah. And as you know, I mean, when you bring a deal to your friends, you own it. It's, some of them might say, well, I thought you did the due diligence. What's going on here? I didn't know this was a problem. I trust you. And, that's why you often see a lot of angels not want to bring deals to their friends unless they really, really understand the mechanics and what's going on. So it's a classic case of, if you go totally unprepared to someone like and then you turn them down and the entrepreneur goes to people who might be your friends, you might warn your friends and say, look, I took a look at this deal. They didn't really have the answers to these questions. I don't think you should be doing it either. So there's a kind of a greater risk when it comes to when you pitch people like yourself and you're not prepared. And there's a risk that you're not going to take the deal to people you like, that also you might not want to actually, your reputation alone might hurt their ability to get money.
One of my favorite things to ask people about who have had some success, because you don't really hear a lot of stories in Canada of people who have successfully raised money. And I'm going to name drop a friend here, Pat McCutcheon, who once started a company, Metafarm Labs, which got just a hair under $1 billion in market cap at its height. I remember asking Pat when he started Metafarm Labs how he went out and raised money. And he said to me that he put together his deal and then he just marched around every large investor he could find on Bay Street and every investment bank until finally he found somebody who is in the business of taking companies public who decided to take them on. But not every company makes sense to go into the public markets. They don't have the tailwinds. It just doesn't make sense for the venture exchange or the CSE. So just in general, I want to give some actionable advice here, or get some actionable advice, I should say. If you were a young entrepreneur and you wanted to raise $500,000 or $1 million and you live in Canada, where do you even go to start?
Well, the first thing you do is you go to Amazon.ca and you buy the big raise. That's the first thing you want to do. No, when you decide that you want to do something entrepreneurial and you want to actually go and raise money, we actually structure the book in stages. So there's 4 stages that we identified for the fundraising process. And the first stage is around ideation. So when you actually come up with an idea to do something, there's some things you're going to have to reconcile. There's some things you're going to have to understand about what your obligations are going to be and what you're actually getting into. And then the stage 2 is preparation, when you decided, I'm going to do this, and what are the materials you actually need to prepare. You've got to assemble your team. You've got to build your financial model. You've got to build your pitch deck. You've got to assemble a data room. You've got to understand how you're going to incentivize people to get along on this journey with you. And stage 3 is when you're actually going out and meeting with investors, and you have to understand what their expectations are. What kind of securities are they going to expect? What's their time horizon? As you were mentioning earlier, when you go to raise money from certain people, they're going to have different time horizons for when they want to have an exit event. So if you fill up your early stage cap table with people who want to see some sort of liquidity event in the first 2 years, you might find you're under tremendous pressure to go forward the public listing before your company is necessarily ready for prime time or before you've actually proven yourself out enough to justify going public. So understanding an element of that is part of part three. And then part four is, if you manage to successfully raise money, what are the things you have to do correctly to be able to go back and get more money? So a classic example of this when you raise money from people is having a good communication strategy with your shareholders. If you keep your shareholders in the dark for 12 months and you only call them up when you need more money or the company is going to collapse, you're in for a very, very ugly conversation. So when you're going out to raise money and you're going through the process of raising, even if it's just $500,000 to $1 million, there's an enormous amount of thought that needs to go into what you're actually doing and what kind of risks you're taking on. And we try to detail those out in the book, covering a wide variety of topics from kind of intellectual property to valuations to securities. And getting a full look at what you're really getting into is the first start to get looking for money.
So just you talking about that there, remember, or it made me remember something that you told me, it might have been a couple of years ago, which is that company CEOs or founders should view their shareholders as an asset on their balance sheet. And
Yes.
that really resonated with me. And I've told a bunch of publicly traded CEOs that exact thing. Now, I obviously pretend that it's my idea, but I think it's so true that if you are a CEO and you have a chance to sit down with a potential shareholder or even your current shareholders, if they walk away from that experience and they can't communicate what the company's doing, or they just, are kind of disinterested because the CEO just didn't do a great job presenting, then you've just lost out on a pretty big opportunity. And I think that goes back to what you're talking about with the importance of communicating with your shareholders. Now, this is probably going to sound a little specific and mundane, but there's also another aspect to this is there could be legal consequences if you raise money and you're not properly communicating with your shareholders. Am I right?
Oh yeah, absolutely. I mean, depending on the terms of the money you're taking, I mean, the information rights you might have to remit back to your shareholders. Like you might even have to prepare audited financial statements depending on the level of the investment and how much capital you've brought in. So there's very serious legal obligations you have to actually communicate with shareholders. You can't ignore those. But going back to your point on shareholders being a tremendous asset, your shareholders are the most motivated people to have you succeed. And you want to give your shareholders the tools to do just that. Like you don't just tell your shareholders, oh, we're revolutionizing this technology. You might want to give them very specific marching orders saying, look, our solution works fantastic for companies, of this size, involved in this kind of activity, involved in this sector in this country. And even if your shareholders don't know anybody who's doing that right now, it doesn't mean they're not going to go to weddings. They're going to go to parties. They're going to go to graduations and receptions and reunions. And they're going to be talking about what they're doing in their life. And that includes what kind of companies they're investing in. So if you give someone those tools to say, okay, if you see a company or you meet an executive or you see someone who's involved in these activities, reach out and let our COO know or let our head of sales know, they can broker an introduction to them. Because these people are tremendous assets to you, especially early on. So it's a big mistake just to view your shareholders as just, the money they already signed up for. You should see them as an asset that can deliver long-term value.
Just to give a little anecdote on, as an example of what you're saying, I recall, I think it was the first trading day of 2019, where everybody went home and they talked to their family about all the money they were making in cannabis stocks, where there was record volume in all the cannabis stocks. And it was likely a result of exactly what you're talking about. People communicating with their networks after making an investment and being super motivated.
Oh yeah, exactly. Yeah. I mean, I remember that tremendous pop in cannabis stocks. And it was probably because, you're all huddled around the dinner table and some cousins, maybe he's got a new car, maybe a new watch, and he's talking about how he's up 1,600% in some name that no one at the table has heard of. And all of a sudden people start chattering about it. People start learning about it. You saw a similar phenomenon with crypto, where you had people for the very first time going home to the dinner table and then people were like, what? You're invested in what? And then there's all of a sudden there's all this more education around it, and people are learning about it, and then some of them are at least choosing to invest in it. So you definitely see that phenomenon.
So something that I've learned in the last couple of years after starting to make private investments, and for a lot of people that are watching this are going to think that I sound naive, but I'll just put it out there. When we started making investments in some of these private companies, something that we've been kind of shocked to discover over the last year is that not everybody invests in just regular common equity. I mean, yeah, we'd see the occasional, convertible structure. But something that we kind of see sort of in that VC world is these types of preferred shares that can actually be really predatory on the company. And it just sort of brings me to this question where I know you follow the public markets closely, and the purpose of this interview is to really talk about your book, but I have to ask, if you're a retail investor and you're looking at some of these companies and you're trying to understand the capital structure, what are the things that you may see that may be a red flag for you as a potential investor in a publicly traded micro cap or small cap?
Yeah, I mean, a company can have a fantastic story, but you absolutely need to understand the cap table of the entity that you're investing in, and not just the current state of the cap table, but as markets shift, what kind of securities might they need to raise with in the future? If you're like a big, sophisticated public company with a very well understood business that's profitable, you're probably just going to be raising with straight common equity. But the reality is, when you're at smaller companies where there's a lot more risk involved, not everyone who signs up to put capital into the business is going to sign up to the same level of risk. So a common thing you've seen talked about in Canadian junior markets is you'll have a name that's really, really great, and they're outperforming on their sales goals, and they seem like they're going to be profitable. And you don't see any kind of sustained upward movement on the stock. And that might be because the cap table is just full of penny warrants that were handed out to early investors, early promoters. And as the stock rises and the results come in and things start to improve, they just dump these into the market and suppress the stock. So understanding the warrants, convertible notes, if there's preferred shares on the cap table, what kind of terms and rights those people have. It's not, I'm not saying that it's going to be a quick process. It can be quite a bit of work to actually unravel that. But you have to have a basic understanding of that, because when you're investing in the commons, you're at the bottom. And when you're at the bottom, you have to understand what's on top of you. So understanding the capital stack. And if a company, for example, is quite distressed and they have to go back to the markets, you might have to realize, well, if they're off plan and I'm sitting on commons, then they might have to raise with commons that come with cheap warrants, 5-year warrants. They might have to raise with a preferred instrument, and those can have liquidation preferences ahead of the commons. So it's understanding the cap table is one of the most important things to do when looking at any opportunity.
If I ask you about some of the more predatory financings you've seen over the years, do you have any anecdotes you could tell of somebody who made an investment or took an investment where the terms you thought were a little bit egregious, without naming names, of course?
No. I mean, I think the mistake you can make is when you're going out to raise money is you can default in your head, oh, I'm just getting offered standard terms. This is standard. There are some things that are expected at certain stages of a company's life. And there are things which can be absolutely egregious and weigh a company down in the long run. And I don't want to dive into too many of these terms, but I mean, a classic one that's seen as quite predatory is a material adverse redemption clause, which can require the company to effectively buy back your position if something is deemed to have gone wrong. That's considered particularly brutal to have in a negotiation. And unfortunately, you do see some entrepreneurs who are so desperate for capital, they'll sign up and take terms that maybe they shouldn't be. And you can't maybe not realize what the consequence of doing that was till you're further down the line. There's really, really egregious anti-dilution provisions as well that can be thrown into a term sheet. And if you just accept it at face value and think, oh, well, this is normal, but then all of a sudden you have a down round and you realize the consequences of what you've done, you might find yourself absolutely shocked. So understanding and having a good corporate lawyer to help you when you make these kinds of investments is absolutely critical, because they'll tell you what they're seeing in the market. And, it varies based on where valuations are and what the appetite for risk capital is. But ultimately, you need to understand what you're signing up for when you're taking terms.
I remember a friend once was raising money on, hopefully he's not watching this, I'm not going to say his name, but it was some sort of insurance tech deal. And I remember him saying to me at the time that They were raising money, and it was unbelievably early stage. They hadn't even fully proven their
Yep.
tech. They had zero sales, and they were going to go try to raise money in the Canadian junior markets, and they weren't exactly sure how they were going to structure that from a capital standpoint. And he came to us, and we were interested in writing a check. And I said, based on I like you, I want to bet on you because you're a friend, but you don't really have anything here other than an idea. So we'll give you the benefit of the doubt because you're the one who's going to put in all the work. We'll go in at $1 million pre-money valuation with the assumption that this is probably going to go public at some point. And then he went back to his lawyer, and his lawyer kind of laughed at him and said, "You should never sign anything for less than $4 million." And I remember scratching my head going, that lawyer just cost him a check, because now I'm not interested in investing. You can come back with the original terms. I've had time to think about it, and I don't really feel comfortable with it. But how often do you kind of see these things where people just start throwing around valuations and they don't really even know where to start?
I mean, the earliest stage valuations are always going to be the hardest because you, as the entrepreneur, don't want to give away the farm. And you, as the investor, don't want to come in at a price that's absolutely egregious. Especially because you have to remember, a lot of early stage ideas are based on new technologies. So the regulatory environment can be very murky. The way governments legislate might not make a lot of sense. If you work in the cannabis industry, you're probably very familiar with how a lot of the government regulations actually chewed up a lot of the companies with excessive taxation and distribution mechanisms, and that ultimately that killed the economics. And also, like, you might not even have a prototype built. You might not understand your unit economics fully. But to your point, you might find that there's people you want to bet on, there's ideas you want to bet on, but the valuation conversation might not make sense. And there are instruments you can use that can kick that can down the road. It is very, very common to see early stage companies raise money with safe notes, so simple agreements for future equity. And effectively, the way those are structured, you can kick the valuation conversation down the road till there's something with more substance. And then you can rely on a larger, more professional institutional investor who comes in to set those price terms that you can help with your conversion. So it's when you meet people with really, really fantastic ideas who you say, like, look, I know you have potential. I really want to participate in this, but you don't want to be setting the valuation where you have a lot of tension between the founder and the entrepreneur over how much you're really worth at this point. You should explore looking at alternative instruments aside from common equity where you have to set a valuation.
Let's talk about the general state of risk capital right now. Is this an okay time to go out and raise money?
Yeah, I mean, if you have a good idea, you can definitely go out and raise money. I think the three biggest hurdles you have right now, if you're trying to raise from angels or venture funds for early stage rounds, is there's three things effectively going on, especially if you're in Canada. But the first problem you have is the movement in interest rates and what the appetite for risk capital is. So I know a lot of family offices and angel investors who historically used to participate in a lot of early stage rounds. And I've talked to them over the last few months, and they're saying to me, why am I going to necessarily participate in these early stage rounds when all of a sudden I can get a great, maybe not a great return, but a real return on a T-bill or on a GIC. I can get 6% on a GIC. Why am I going to participate in risk capital? The second consequence you have, particularly in the Canadian market, is you're having a reverse wealth effect with housing. When housing was ripping up, somehow homes in Toronto were ripping up, $20,000 a month in value. You had a wealth effect where people were much more confident in throwing around capital into risk opportunities. But now they're starting to see all this new information come in, new comps, and they're saying, okay, my house might be losing hundreds of thousands of dollars over a quarter, over several quarters. I don't want to spend as much participating in risk capital. And the third problem you have is people effectively being stockholders in historical deals. So people who were allocating in 2018, 19, 20, all of a sudden find that that path to liquidity for those investments is not there. They're not going public. They're not getting acquired. And all of a sudden, people who have a lot of money in the private markets cannot recycle that cash into new opportunities because they're effectively stuck. So the combination of these factors create a lot of problems. But at the same time, if you have a good idea, there's still risk capital out there. You just need to be more buttoned down than ever if you're going to get it. So that's why, like, we talk about the book, all the ways you can get buttoned down to do it. You have to remember, I mean, there was a great anecdote, and I don't want to name the fund, but with the FTX deal, there was a fund that put quite a bit of money into FTX. And if I recall the story correctly, they sent due diligence questions to FTX. FTX didn't even bother responding to them. and yet they wired the money anyway. So I think in the current market, investors.
That wouldn't have been one of the most prestigious pension funds in Canada, would it have been?
I definitely would not name them here, but there was an anecdote about that happening, and now it seems like with the appetite for risk capital, you're not necessarily going to be able to do that anymore, where you can just ignore these massive due diligence questions and just expect people to wire the money in. All of a sudden, when a pension fund or investment fund get a real return in other securities, they're going to be far more discerning when looking at your opportunity. So being buttoned up and understanding what you have to do and what the obligations are and what the risks are is more important than ever.
Do you think that's a big problem with a lot of these sort of early stage companies, is that you got some people who are great at raising money that are terrible operators, and some people who are great operators but terrible at raising money? You think you can find both of those, or do you think that those are just two totally different personality types?
One of the general partners at my old fund used to talk about promotional CFOs versus technical CFOs, and he would talk about how the promotional CFOs are really good at storytelling. They can go out there, they can raise money, and they're really good at it. But they're generally pretty terrible at actually crafting financial statements and doing long-term financial planning. And then there's the technical CFOs who are very good at that, but they're just not the kind of storytellers. It's very, very rare when you can get both. And to your point on the people who go out to raise money and the people who can operate, I see the same distinction with a lot of founders. I think we have a bit of an illusion, quite frankly, because we see guys like Bill Gates go out there, found it, and then run it for several decades. Zuckerberg, those are always the exceptions. The kind of early stage people who are really good at raising money generally get replaced out for a professional operator over time. And that's not to say that they're not bad people or they're not good business people. It's that people who are really, really good at storytelling and raising money aren't necessarily the people you want professionally operating it in the long run. So there's definitely a lot of changing out of executive leadership over time.
Do you think it's important, if you are raising money and you start going out and talking to some of these funds or capital advisory, firms, that when you sit down and talk with them, you think you're sitting down and they're there to help you, and then the next thing you know, they're trying to suck fees out of you, and you realize maybe 6 months after working with them that they provide no value. For some reason, you're paying them, and they're taking a chunk of your cap table, and you're just sort of left scratching your head going, okay, is this how this works? I see that a lot in the Canadian junior markets. And I feel like when I see certain people on Twitter who are VCs that have big followings, I'll throw one example. I saw Jason Kalinakis brag about doing that on his podcast, talking about his VC firm, how he felt like he got a bad deal from a company, so then he forced them to give him a bunch of advisory fees, which again, the context may not be as bad as I made it sound, but you just kind of see this stuff happen all the time, where you think that somebody is hiring somebody who tells them that they're going to help. And then, you talk to them 6 months later and it's like that person did absolutely nothing. They just basically stole from the company.
I'm not going to name names, but when you have an early stage idea with a lot of potential, that can attract a lot of people who are fairly predatory, who can view you as kind of a, doe-eyed babe in the woods, and they can definitely scare companies into signing up for things they probably shouldn't be doing. I mean, there are lots of people who say, look, I'll open doors for you. I'll host these venues. I'll pack the room with angel investors. Everyone in this room can write $1 million check minimum. And you got to kick me, 25,000 a month or whatever, 50,000 a month. Give me this chunk of your cap table, et cetera. You can find that you've quickly given away the farm and gotten yourself in a lot of trouble when signing up for these deals. It's really, really important that if you meet these kind of people who are going to promise you, oh, I'm going to do the road show for you, I'm going to give you this, I'm going to give you this, that you really understand what you're signing up for. Because there's a lot of people, on Bay Street, on Howe Street in Vancouver, who will promise the world to you and will happily, take you for a ride or extract such an enormous chunk of equity from your company in exchange for them offering whatever they're going to offer you, that you might find that you regret it. So it's easy when you're starting out early to think that these people are going to save you because they talk a really good game, and they always do. But you really need to understand what you're getting into and whether or not you're going to give them cash up front, whether or not it's contingency based, whether or not there's a minimum valuation attached to the money that they're going to promise to get you. You really need to understand what you're getting into if you're going to talk to these people and sign up.
And something I've sort of learned over time as growing in my career is that when you get around some of these people, you can't help but feel a little bit anxious that like, okay, this person's really well connected. They talk to a lot of people on the street. If I say no to them, there's going to be consequences here, and this could really hurt my deal and my reputation. But the thing that I've kind of learned over the years is that those people tend to not actually have that strong of Rolodexes in the first place. But it's easy to feel that way when you're starting out and you don't know any better, because there's not that many advisory firms to go to in the first place.
Yes, no, it's very, very easy to, especially when you're outside your field of expertise. A lot of people raising money for young companies, especially tech companies, you might not have much of a financial background. You might not have a good understanding of capital markets. And as I was saying earlier, these people can talk a very good game, and it can be very easy for them to make you believe you're going to be done. You're not going to get a nickel. It's like, I'm the one who's going to take you to the moon. And they'll try to romance these young founders into signing up for these deals. And it's somewhat unfortunate that we have such an ecosystem with that now. And as you know, like one of the consequences of signing up for some of these firms is that race to go public. A lot of the largest, most sophisticated companies who raise venture capital stayed private, 8-9 years raising funds. I mean, Robinhood Markets, for example, I think their Series A was in 2013. They didn't go public till 2021. But sometimes when you sign up with these advisory firms, it's that bit of a deal with the devil where it's that race to go public before you're ready for prime time. And then you might find very quickly you're a public company with public company reporting obligations. The business isn't moving ahead, and you've been completely orphaned by the analysts in your space. And you're kind of suffering along in a very, very brutal existence because that was the price of signing up with one of these firms. So it just goes back to what I was saying earlier. You absolutely need to read the fine print, and don't be afraid to go talk to other people, talk to other founders, get people on an advisory board who can talk to you to see if this is normal, and then try and figure out if you want to go forward with that relationship, what should it look like?
So Michael, we'll wrap it up from there. Thanks very much for hopping on here. For anybody watching this that wants to get a copy of the book, where can they go to?
So Amazon, it's available on most online retailers. So Amazon, Indigo. It's not available for physical purchase, so you can't go to the store, but it's available online for order. So if you want to get the copy of The Big Raise, it's on Amazon.
Awesome. Thanks so much, Michael.
Thanks.
All right, everybody. Thank you for watching. And if you could do me a big favor, please smash that like button, subscribe, and ring that notification bell. Also, let us know what you think in the comment section.